Good morning, everyone. This is Curtis Hawks with Insurance Agency Marketing Services. I am the Chief Marketing Officer as well as Head of Life Distribution over here. And we're really excited to have everybody on the call today. We've got a lot of good topics to cover in regard to where life insurance fits in the current climate, as well as what we see going on in the future. And then we've got some really good tools that we're going to be talking about that will help you market and generate more life insurance business going forward. So before getting into that, I did want to take a moment to mention everyone some of the other ways that we have to help partner with you in your business. There's a variety of different resources that we have available for our producers that can help you market, whether it's digital, it's brick or mortar, really wherever you're at and what you want to accomplish. There are different ways that we can make a very positive impact in your business to help you generate more clients and get in front of more people. In addition to that, we've got our IAMS business builders, and this is a great way to get straight cash going into your pocket, whether it's through our referred producer program, which are some of the biggest checks that we cut, but it's a great opportunity for you. If you like what we're doing and the services that we're providing, send people our way. You'll get checks cut out to you on a quarterly basis on their business. You don't have to do anything. We'll take care of everything. And then as well, our marketing reimbursement program. And this is a great way to increase the size of your marketing budget. And we're dumping additional money into your business to help you get in front of more people. And so feel free to reach out, talk to your sales director, but both of those are great programs to take a look at that can help make a positive impact in your business. So 2020, as we all know, we've had a crazy start to the year, and we're kind of right in the thick of all of this COVID madness. And so a lot of advisors have had to go through a transition this year with how they're doing business, with how they interact with individuals. And so there's been a variety of those types of changes that have gone on. But what I would tell you is that there's a great deal of opportunity for life insurance sales right now. We have seen a significant uptick from a life insurance standpoint because I think you have a lot of individuals out there where when you have something like a global pandemic go on, and probably rightfully so, they're going back and they're checking their life insurance. They're looking at if they have it. I mean, historically, you look at LIMRA, and the general population on average is underinsured. And so this has caused a lot of people to reach out. It's also caused a lot of people to engage with a lot of the marketing that advisors are doing. And so now more than ever, this is a good time to be talking about life insurance, not only for a death benefit, but also the living benefits that are available with life insurance as well, because that's also a concern of individuals is, not just what happens if I'm not here anymore, but what happens if I get sick and come back from that? How does that financially impact us? So there's right now, like I said, a huge opportune time to get in front of people and talk about life insurance. In addition to this, and I think this is a good point to make, but we plan for future financial environments as much as we plan for now. And I make this point because the current climate, not only does it help facilitate the need for life insurance with what's going on, but when you look at going forward, where we're at right now versus where we think we're going to be 5, 10, 15, 20 years from now, there's a significant amount of planning that can go on. Planning for the future, planning for future changes with how we save for retirement. And one of the core areas that's driving that is legislative changes. And I wanted to spend a little bit of time talking about that today because that really does shape, in a very profound sense, how we interact with consumers, the types of plans that we put together, the type of recommendations that we do, all of those types of things. So at the beginning of this year, we had the SECURE Act get passed. Now, the SECURE Act had 29 provisions that affected a variety of different retirement mechanisms. And when you look at it, it was one of the most profound legislative acts since the 06 Pension Protection Act that went into place. And so it impacted a variety of the different areas that we do planning around, whether it's RMDs and those getting pushed to age 72, and 401ks for that matter. drafting provisions that not only made it possible to get annuities as well as lifetime income options in there, but it greatly expanded the pool of people that can participate within 401ks. In addition to that, you saw dramatic changes to IRAs with the elimination of caps on contributions into IRAs, as well as stretch IRAs. And that was one of the more dramatic changes in the plan, but shifting that from the ability to stretch an IRA if an individual wanted to putting it down to a 10-year time frame. And so part of what we have to do when we look at different legislation coming down the pipeline is what is the future impact of that? And then what is the, what is the goal of the legislation? What is the goal of the plan? How does that work? And so when you look at what the Secure Act does, and I use this analogy quite a bit, and I'm sure many of you on this call today talk about this as well, but would you rather pay tax on the seed or the harvest, right? We have that conversation all the time to where it's better to pay taxes on the seed right now, and then we eliminate income taxation on the harvest. But when you look at the Secure Act, a lot of what that did and built out was essentially it made it easier for individuals to contribute funds into a qualified account. So basically what Congress is saying is we're going to bypass increases in income taxation on these qualified accounts right now to let those grow to potentially be able to tax them or tax a larger pool of money on the back end with the harvest. And the thought process behind that is not necessarily because the intent was to increase taxes on individuals in the future, but by default, let's take IRAs and the stretch IRA as an example. If you could stretch that income over the course of 30 years, that's probably going to generate a lower marginal tax rate for that beneficiary than having to take it over 10 years. And so it's a way to increase tax revenue without having to necessarily increase taxes. And so one of the things that we did earlier this year is we put together a two-part package, which honestly has been one of the most popular packages that we put out. I think we had 800 reps in the span of 24 hours request this when we initially rolled it out. But it's a two-part piece. One is a deep dive into the Secure Act, what it is, what it does, what it means, all the frequently asked questions. And then we put together a second piece to this, which is the Secure Act sales tips. And what it identifies is over 8 different concepts or ideas that you can utilize to leverage changes within the Act to show your clients how to generate better leverage, yield, and to get their assets into a more tax advantaged position. So I would encourage all of you, if you haven't had a chance to see this yet and you don't have it, reach out to your sales director and they can get these copies of these over to you immediately. But it's a wealth of information. Second big legislative change that we've had has been the CARES Act. Many of us have clients that have received money. Maybe some of us, you've got the PPP loans that are going out there. But it was a capital infusion into the country. And so Congress passed that in the hope of helping people kind of tread water and get through COVID. But one of the big core takeaways of this is that it's adding almost $2 trillion to the federal deficit. And so when we look at that, what does that ultimately mean? What do we think is going to happen in the future? As we start taking on debt, and we already take on debt at a very rapid rate, having something like this happen to where that's accelerating even further is certainly going to be a consideration as we go through and we look at how are we doing planning and how are we allocating things. And so one of the things that we did as well in regard to the CARES Act is we put together a consumer-facing package. So while the Secure Act is more going to be along the lines of agent information and training in regard to the Act, the CARES Act package is all consumer-facing. And so we've got 2 pieces there. One that breaks down what the CARES Act is, where the money went, and what the future impact of that debt increase is going to be. And then we put together our Smart Wealth Accumulation Guide. And it is a great guide that goes through the different ways that you can save, whether it's taxable, tax deferred, tax free. And it talks about the 4 core challenges in retirement that every retiree is going to have to face, which are taxes, healthcare, inflation, and market volatility, and then frames where life insurance can help be a solution for that. So again, with the CARES Act package, if you don't have this yet, it's a really good tool that you can use. We've optimized it for digital presentations. So it's a great piece if you're doing Zoom calls or GoToWebinar that you can pull up and go through those things with the consumers that you're meeting with. Just give us a call. We'll get copies of it out to you. But again, really good resource that you can utilize. So in addition to the CARES Act, as many of us are seeing right now up on the Hill, they're actively in discussions in regard to what the next package is going to be. And I think at this point, I don't know that it's necessarily a question of are they going to do another relief package? It's what are they going to do? And I also think that when you look at it, everybody seems pretty comfortable up there at least $1 trillion. So we're talking about in the span of 7 months, potentially $3+ trillion of federal aid going out to the consumer base. And so all that points to how are we going to recoup that back? Well, the government runs off of two primary sources of revenue or income, which is government issued debt and tax revenue. So if we're looking at this and we see that, okay, debt is at an all-time high, we're tacking on even more this year than we normally would, that's going to precipitate future tax increases. And I know we talk a lot about, do we think taxes are going to be higher or lower in the future? Well, most people think they're going to be higher, but when is that going to happen and how is it going to happen? Well, it's a good question and oftentimes it's hard to answer, but that gets us into the TCJA, the Tax Cuts and Jobs Act of 2017. When this legislation went through, this is how we currently file our taxes. This legislation is set to sunset December 31st of 2025. So we've got a window here of about 5 years before we know that we're going to have new legislation come out. When you look at the Tax Cuts and Jobs Act, initially that was marketed as an individual bill. So it was marketed as an individual bill that 85% of the benefit was to the consumer population. The issue with that statement, though, is that when you look at most businesses, let's say you're an LLC or you're an S Corp, well, do you file a corporate tax return? Well, you get a K-1 and you file it on your individual income taxes. And if you're an LLC, again, to put an asterisk on that, it depends on if you're an LLC filing as a sole proprietor or an S corporation. But essentially, C corporations are filing at the federal level. So what that ultimately meant was, when we talk about consumers, the majority of the individuals are all getting lumped in together, whether it's a small business or whether it's a individual, because that's flowing through under K-1 income. So when you look at that, a lot of the provisions were designed for flow-through entities. So if you look at how the legislation is currently drafted, right now how it's set is if nothing happens, it's going to sunset and revert back to what our legislation was or what our tax code was prior to this. Well, one of the big core areas that increased with the Tax Cuts and Jobs Act that was a big benefit to individuals was the estate tax credit. It's almost 23 million or just over $23 million currently. That in and of itself is set to retro back plus inflation to what it was before this. So I think when we look at the current landscape and we look at what we think is going to happen in the future and the impact of future legislation, I think we can point to a pretty defined moment going forward. We're taking on massive amounts of debt right now. How we're currently filing our taxes is set to sunset in 5 years. And so I don't think anybody realistically thinks that, okay, when they go to replace this, we're going to do another round of tax reduction. They're going to do tax increases. Now, whether that is through the use of actually increasing tax rates, or the other way to go about it is how do we create different scenarios where we can increase tax revenue without technically increasing tax rates. A good example of that within the Tax Cuts and Jobs Act is alimony, as an example. So pre-TCJA, if you had a couple that got divorced, the individual who is paying alimony to their ex-spouse is paying that money, and then the ex-spouse that's receiving it was then filing that on their income taxes and taking that income. That's how it had worked forever. Well, the TCJA made one simple switch. And what it did was the individual paying the alimony could no longer deduct that off their taxes. Instead, they paid the taxes on it, and then the ex-spouse got the net amount. Well, if we take a step back and we look at this for a moment, and you've got one spouse paying alimony to an ex-spouse, which one probably is making more income? It's the one paying the alimony, right? So then theoretically, that one paying the alimony should be at a higher income tax bracket than the ex-spouse receiving it. So in effect, what Congress did was, without doing I'm doing air quotes here, a tax increase, they effectively increased the amount of tax revenue that they got off the same dollar amount changing hands. And unfortunately, in this country, roughly half of all marriages end in divorce. So in effect, a tax increase happened on roughly half the population. So I use that as an example because while Congress might not necessarily increase individual tax rates in the new package that's going to come down the pipeline here in a few years, they're certainly going to find different ways to increase tax revenue, just like they did with the SECURE Act at the beginning of this year. So something to keep in mind, something that we watch. But again, I think the big takeaway with that is taxes are on sale right now. We know we're in a lower tax revenue, tax rate environment now than we will be in the very near future. So this creates a huge opportunity for planning. It creates a huge opportunity to meet with individuals and plan for the future and drive a lot of life insurance business. So as we talk about life insurance strategies, we've got a few different things that I wanted to go through today. So first off is a tax offset strategy. So the idea behind this is transferring wealth to loved ones can be a positive life-changing event, but as we know, taxes come with that. So a tax offset strategy is designed to try and reduce the amount of income tax that's paid by the beneficiaries out of pocket. So the majority of the retirement accounts that exist in this country are qualified funds. Roughly 75% of the money in retirement savings accounts are qualified. So part of what we're trying to do on this is go forward and look at what do we think the value of those qualified funds are going to be, and then what do we think the income tax liability is going to be going forward, and then we're working backwards to extrapolate out how do we use pennies to create dollars to mitigate that income tax liability. So as an example, we've got John who has accumulated sufficient assets outside of his IRA and wants to leave a legacy to his daughter Jane. So when we look at this, we've got a few assumptions here. So let's say John's 65 and he's going to live to 90. We've got Jane who is 40. He's got $1 million in his IRA. And what we're assuming is that we get a net average 5% rate of return, and that he's in a 30% tax rate bracket, and we're assuming 39% for Jane. Now, part of what we're factoring into this is we're looking forward over the next 20, 30, some odd years, and we're making the assumption that we are going to have higher taxes in the future. And we actually are going to be rolling out some new software next Monday, and we'll talk a little bit about this, but part of what that software allows us to do is we can run a variety of different scenarios going forward into the future of what we think different tax rates are going to be and the impact that has on the current retirement accounts that we have. So it can help give a little bit more clarity to how we position those assets. But in any case, when we look at this, after John takes RMDs, at the end of this at 90, we've got an estimated income tax of $381,465. And so if we were to take those RMDs that are generating off of his IRA, then we can get a $566,000 life insurance policy. What that in effect does is, one, we use pennies to create dollars to offset the income tax liability, and then also replenish some of the taxation that occurred while John was alive, and maximizes the legacy to $1.162 million versus what it would have been. And just to look at this in more of a flow chart format, you can see essentially what we're doing is we're spiraling off a portion of the income that's generating off of the IRA to fund the life insurance policy. And again, it goes back to that mentality of, do you want to pay tax on the seed or the harvest? We have a window of opportunity here over the next few years and going forward to pay taxes at a lower tax rate than we know we're going to have in the future. We also know that Congress has acted to try and shorten the time frame that a beneficiary can take income. And the byproduct of that, the end result of that is that you have to take a higher income amount each year, which would then theoretically increase what your marginal tax rate might be because of that. And so this tax offset strategy is a great way to kind of forwardcast and look at what do we think things are going to be like, and then let's take advantage of a low tax rate environment right now. And ultimately, the end benefit of that is we were able to pay a lower total amount in income tax to the government. So this this concept, it can make a lot of sense for a lot of individuals. Somebody that doesn't necessarily need all of their IRA assets, somebody who's concerned about generating a larger legacy to leave to their beneficiaries, somebody who maybe has different pools of assets. So when they're looking at their retirement picture, they know that they're going to have some money left over. So if we know we're going to have some money left over, how do we transfer that in the most efficient way possible and create as much leverage as possible, as well as reducing down the impact of taxation on those funds? And here's the other thing about this strategy too, is when we talk about this idea that life insurance is essentially an asset in the overall portfolio. So you don't necessarily have to use a guaranteed universal life contract on this. In this particular scenario, I use that, but that's not to say that you couldn't use a cash accumulating type product. It's not to say that you couldn't partition funds out and do single premium life insurance in this scenario. They just all have different tax impacts based off of what it is that you're trying to do. But with all that being said, that life insurance wrapper of the death benefit will always be income tax free with any of the things that we structure. So something to keep in mind, because with this base concept, you can get very creative with what it is that you're doing. So asset max planning. When properly planned, life insurance coverage provides balance, stability, and diversification. The tax advantage features of a life insurance policy, such as tax-deferred cash value growth and a tax-free benefit, can help clients maximize the transfer of wealth to loved ones. And when we're talking about the asset max idea, there's a couple of different things here. One, it creates diversification within the overall portfolio. Life insurance can be a non-correlated asset within an overall portfolio. And then secondly, it is one of the most efficient vehicles for the transfer of wealth. And I want to talk about diversification for a moment here, because I think the way we look at diversification is going to evolve, just like many things have evolved during this time of COVID. I think that's going to continue to evolve as we go forward in our plans. But a lot of advisors spend a significant amount of time talking about what I refer to as vertical diversification. And what I mean by that is diversification amongst risk tolerance. So when we talk about on one end of the spectrum, savings accounts and CDs, to the other end of the spectrum, when we talk about individual stock ownership, et cetera, and then everything in between. I think an equally important conversation as we go forward is going to be horizontal diversification. And what I mean by that is diversifying assets amongst tax treatments. If we know that the two biggest expenses that people have in retirement are taxation and healthcare, if we know that we're in a low tax rate environment right now that is going to have to go up, that is going to be an equally important conversation to have. And that's going to be a bigger part of the planning process that we go through, because at the end of the day, we've got to work around whatever Congress is going to come back and tell us, right? So we might watch the stock market and we're watching for corrections and all those types of things, but Congress will roll out different tax packages that impact us on a consistent basis. And so being able to have the flexibility, just like when we talk about the market, having the flexibility to move money in and out of the market and utilizing different investment vehicles, we're going to need to have the ability to have different pools of assets that are taxed differently, so that way we can mitigate tax rate volatility, because we can't project what's going to happen over the next 10, 20, 30, 40, 50 years. So going back to asset max planning, wealth recovery, I think this is a good topic to discuss, but the death benefit of the life insurance adds value to a client's overall wealth transfer strategy by helping to potentially recover some of the portfolio value lost due to recent market declines. We've been doing a lot of concentrated stock concept cases here recently, and we've had a lot of volatility in the market. Market's up right now, but you've got a lot of individuals out there that might be in a loss position or have different positions that are in loss. And life insurance, especially and specifically if we've got a pool of assets where we know we're not going to necessarily spend all of that down during our lifetime, can be a great tool to, one, help a client be able to reduce the amount of income taxation on their income by recognizing some losses. And then secondly, if that money was earmarked to transfer to the next generation, we can build that average stock price through the death benefit and the internal rate of return on the death benefit back up into a gain position. So that way, ultimately, that beneficiary isn't losing anything. And then secondly, this is a great way to manage the cost of long-term care as well, to where if we have an LTC event, that can decimate a retirement account just as easily as a market correction. And so again, we're using pennies to create dollars to fund those different types of risks and recover wealth and maintain the level of wealth that that client has accrued. So in this scenario, we've got Jack, age 61, owns an investment portfolio. He's got 1.3 million in bonds as well as 3 million in stock. He's experienced some decline due to market losses, and that's obviously causing a direct impact in the legacy that Jack wants to leave. He plans on retiring at age 65, and his retirement income needs are satisfied by their accounts. So this is excess money that he's been able to accumulate over his lifetime, and then he's got other pools of money that he's planning on living off of in retirement. So, and there's a couple of different, and we'll talk through a couple of these different scenarios, but there's a couple of different ways that you can do this. So those assets that, again, are in a loss position, you can liquidate some of those. You can do one of a couple of things, and this really is driven off of, do we have an estate tax issue or not, right? So if you want, we can liquidate that. He can house the life insurance within his estate. If we want to get an ILET set up, then we can fund that. And there's a couple of different ways that we can do that, either using annual gift tax exclusions, or we can tap into the lifetime exclusion, because again, it's 11.58 per individual. And again, as I mentioned, I don't think very many people think that that's going to be preserved when we have the new rollout at post TCJA. If anything, it's going to revert back. And then there's also a significant amount of discussion of whether it actually retros back to what it was pre-TCJA or if it goes even lower than that. But in any case, you're liquidating a portion of that. Then you're utilizing those funds to fund a life insurance policy. Now, again, in this scenario, we're using a guaranteed universal life contract that also has current cash accumulation on it. So there's different iterations that you can do with this, whether we want to use an accumulation focused product, whether we want to use a GUL product, whether we want to use a tandem, secondary death benefit guarantee product with an indexing chassis. But you've got multiple options that you can look at based off of where the client's at. What I would tell you is, if you've got a prospect that you think is a fit for this particular type of scenario, just give us a call, talk to one of the sales directors. They can help you with that, and they can walk you through what option might make the most sense on that particular case. So when we look at this, we can guarantee the coverage to age 95. And then on the current projection side, we can have that cash value endow and continue to grow through age 121. So part of what you layer into this is this will help index for inflation in the latter years when we start talking about 20, 30, 40 years down the road. So as I mentioned, with this particular concept, one of the things that we're able to do is recognize a loss, deduct that on our taxes, and then through the inflated death benefit, we can increase what would equivalently be the average share price of what the portfolio was before. So now you're back into a gain position and you've converted taxable dollars into tax-free and you've created a tax deduction for the client as well. So this concept can make a lot of sense, and then you really truly do have life insurance as an asset within the overall portfolio. So when we look at who this might work for, somebody's got stocks, bonds, CDs you're not necessarily going to be losing money on, and depending on the type of non-qualified annuity, you might not as well, but somebody doesn't necessarily have to be in a loss position for this to work really, really well. We're talking about this in the concept of trying to recoup wealth that's been lost in the marketplace, but an equally important discussion is how do we maximize that? So you've got dollars here, how do we create additional dollars off of that on a guaranteed basis and generate a guaranteed rate of return? Generally speaking, a lot of these cases we'll do for clients in that 60 to 80 range where they've got a little bit more clarity about what their retirement's going to look like, what income they're going to be living off of in retirement, et cetera. It's not to say that you can't go younger on this. We'll see this particular concept with business owners quite a bit that are younger. Oftentimes what we're using is a cash accumulation vehicle for that, and it's a way for them to diversify their holdings. So if they started a business and are investing in themselves and they've seen that actually work, this can be a great way to, in advance of some type of a succession plan, to start partitioning money, either via 162 plan or defined benefit plan or what have you, depending on the scenario, and have that separate non-correlated asset of cash that they specifically have access to. And then another key point on this is it's a great way to have some level of predictability of what's going to transfer at death. Again, we can calculate out the IRR on the death benefit. So every single year we can look at and see what is this average rate of return and how does this compare to other assets if we were going to allocate our funds there. So it's a great way to go about doing that as well. So talking about IRR, you can see here that we've done a projection on this. So we liquidated that portion of that account. We've generated that $3.25 million death benefit. And again, we're preserving the life insurance wrapper on any of these concepts. So that death benefit is tax-free. So if you look at this going forward, what that internal rate of return is, those are guaranteed values. We know that that's what the return is. We can look at it every single year. Well, when you factor in taxable equivalent yield and look at what would you have to earn otherwise in other investable assets, that starts to be a discussion of, well, can we hit that consistently year over year? Maybe, maybe not. But in the context of this, what we're trying to create is a predictable rate of return that's, to a certain extent, set it and forget it, and we know this is what we're going to get, regardless of market performance. So when you can shift the narrative through story selling, through talking about concepts, and we start talking about rates of return, they've got dollars in their accounts, and they've got different ways that they can allocate those dollars. When we can start shifting that narrative and talking about, well, there's different ways that we can reposition this to get different rates of return, some of which are guaranteed, some of which are not, what makes sense, what happens is people start to view it as taking money out of their left pocket and putting it in the right pocket. And life insurance at its core always has been and always will be, if it's a good deal, people will buy. And that's part, really, at its core, what we're talking about is there are different types of things that we can do to generate different types of returns using different vehicles. And this is a way to bolster a portfolio and give a guaranteed rate of return to an individual that's a tax-free return. So third concept I wanted to talk about, and going back to the original, again, we run a lot of scenarios on those. If you've got a client in mind, give us a call, talk to a sales director. They can walk you through that and they can illustrate that whole concept for you. So give us a call. So pension maximization. Pension Max has been around forever. It's been around for a very long time. And some of you might be wondering, why am I talking about this on this call? I'm familiar with Pension Max. Well, with Pension Max, we're kind of seeing a resurgence with that. COVID is impacting all sorts of businesses. And so one of the things that we're seeing out in the marketplace is you've got a lot of businesses that are starting to look at doing pension buyouts that are trying to incentivize people to retire early. And so we're seeing a significant uptick in pension max designs here over the last few months. And that, take a step back and just talk about marketing in general, that's one thing that I would mention to everyone as well, is there are a lot of opportunities within the marketplace. You've got businesses that are being negatively impacted due to COVID. You also have businesses that are being positively impacted by COVID. And traditionally, when we talk about marketing and we look at what advisors do, you're generally speaking going to be doing broad-based marketing, whether that's direct mail, whether that's workshops, radio, doesn't matter. And what advisors normally do is you're running those campaigns on a monthly basis in volume to a bulk audience, and that's generating response back, and that's how you do your prospecting and marketing. What we're seeing right now and what we see going forward is the usage of what we refer to as micro campaigns. So while you can still do broad-based marketing, part of what we need to look at, or part of what you should be looking at, is what is going on in your local marketplace. Because now more than ever, there's a lot of different movement at the local level that facilitate life-changing events, whether it's retirement, whether it's a new job, whether it's birth of a child, whether it's all those types of things. And so one area where we're finding a significant amount of success is in running targeted micro campaigns. If we know we've got a university in an area that is doing some furloughs or layoffs, that can generate a big response. If we've got a company that's doing layoffs or doing pension buyouts, that can generate a significant amount of response because you've got an individual that has a very big financial decision that they have to make, and they've got a deadline to make it by, and they can't take it back once they make that decision. And so they want to talk to advisors. So I mention that to everyone because that opportunity is going on throughout the country. And if you're not quite sure how to capitalize on it, one of the things that we do here at IAMS, and I would encourage you to take advantage of it, is we'll do a custom marketing analysis. And what that entails is we'll go through all of your marketing assets, your business, what you want your business to look like, what you want it to grow to, and then we'll run population densities, we'll look at other advertising going on, we'll look at everything. And ultimately what comes from that process, from that exercise, is you get a custom marketing plan of different options that you can implement within your practice to help achieve your goals. And the best part about it is not only will we help you implement it, but as I mentioned at the beginning of the call, we'll help you pay for it through our business builders and new producer bonus programs. So if you're interested in a custom marketing analysis, give us a call. We'll set up a time to get that done, but you would be amazed at what we can come up with. And again, we have a vested interest because we don't have success without the success of our advisors. So I'd encourage everybody on the call, if you haven't done this with us, to give us a call and go through that process. So in any case, getting back to Pension Max, generally speaking, I mean, most of the people that are going to be impacted by this are going to be 55 to 65, maybe a little bit older, and they haven't begun receiving their pension benefits. So the idea behind pension maximization is that individual is going to be offered a few different payment options, and they can do a life only, or they can do a joint, or in some scenarios, they might get a lump sum option as well offered. If they're doing joint, there'll be, generally speaking, a couple of different iterations of that, whether it's a spousal option with 100%, 75, 50 is normally what you see. And so as you can imagine, the life only payout has the highest income because again, once that individual passes away, that's it. And then the higher income for joint is going to have the lowest income. So what we're talking about doing in that scenario is, well, if we know that we want to make sure that there's an income that both spouses don't outlive, then you're going with the joint option from an income standpoint. Well, if we took the difference between the life only payout and the joint payout, and we use that to purchase life insurance, then can we generate at the death of the first individual a high enough income to be equal or more than that spousal option? And if we can, that can make a heck of a lot of sense. So by taking the single life option and using that extra monthly income, we can maximize the value of the pension. And there's a few different ways that we can maximize that. So first off, that pension is 100% taxable. So every year that you're getting income off of that, that's going to be 100% taxable as income. Well, when you have a death of that first individual, let's say it's the person that had the pension, you now have a tax-free benefit that is paying out to that beneficiary. So if you were to dump that into a SPIA, that's a non-qualified SPIA. So ultimately what that means is the majority of that income going out to that surviving spouse is non-taxable, and a small portion of it is taxable interest, which, as we know, SPIAs aren't going to necessarily generate a ton of interest. But here's why that's so important. As we've talked about, do we think taxes are going to increase or go down in the future? We think they're going to go up. So if we know that we're entering into an increasing tax rate environment, and we also know that if we've got a married couple, when that first spouse passes away, that's one of the most challenging times of that surviving spouse's life. There's bills, finance, all those types of things get disrupted. The ability to convert a 100% taxable income stream into a predominantly non-taxable income stream is an incredibly core element of making sure that that surviving spouse doesn't outlive their retirement income. The second aspect of this is the death tax. Now, when I say death tax, I think a lot of advisors think about in the context of a state inheritance tax or the federal estate tax. That's not what I'm talking about. There are different tax brackets based off of what you're doing in your life. And so for a married couple who is married filing jointly, they've been able to enjoy, on average, lower marginal income tax brackets during their life. When you have an individual pass away, and now that surviving spouse has to file their taxes, they're now filing as an individual. And to give you an example of that, if they had an $80,000 a year income while they're both alive, they were filing taxes at a 12% top marginal tax rate. That surviving spouse, if they still have 80,000 of income, is now filing at 22. It doubled because she's now a widow. And so that's something that we have to account for, because not only when you had that first spouse die, on average, does your income tax liability double, but we think taxes are going to go up in the future. So how is that going to impact us? So the ability to take and maximize and create a lifetime income through pension maximization, and then also convert that in the future to a virtually non-taxable income stream that also mitigates that doubling of income taxation in the future when somebody is on the tail end of their retirement accounts, can be a very profound, powerful concept. So as we just mentioned, we can use a variety of options to do this. The other element of this as well, we mentioned taxation and healthcare are the two biggest expenses in retirement, and the impact that an LTC event can have on an overall retirement portfolio. One of the things that we can do is we can layer in a chronic or LTC benefit into the life contract, so that way they're not having to come up with money out of pocket to help cover that expense or dip into other pools of assets in order to manage it. So one of the things that I wanted to talk a little bit about today was we've got some new software that we're rolling out next week, and we're going to be doing a call on it on Monday at 10 o'clock Central next week. I would encourage everybody that's on the call today to be on that call next week, because conceptually we've been talking a lot about the impact of taxation and different strategies. What this software allows us to do is we can go in and we can extrapolate out the lifetime of income taxation that that individual is going to incur for the rest of their life. And we can run a variety of different scenarios on it that illustrate increasing tax rate environments, flat. If we actually wanted to illustrate a decreasing tax rate environment, we could. And so there's two ways that we can utilize the software. One is somebody that's accumulated assets on a qualified basis, and what does that look like? And then secondly, we can illustrate somebody that's in their saving years. Maybe they're younger, maybe they're Gen X, maybe they're millennial. And we can look at, okay, if you save on a qualified basis, what does that look like, and what is the impact of taxation versus what if we partitioned a portion of that over into a tax advantage asset? What does that look like? And we can compare the two. And so it's going to be a great opportunity, I think, to help a lot of people. And we've also got a very well built out marketing package around it. So if you're wanting to talk about this and you're wanting to do virtual workshops, if you're wanting to do video, if you want to do email, we're going to cover all of this in the call next week, but there's a variety of different ways to get that narrative out and get in front of additional people as well as existing clients and help them. So Life Insurance Awareness Month. So probably some of you on here are wondering, why are we talking about this in August? I mean, life insurance has just been insanely busy this year. With the pandemic and everything going on, we've just seen a significant amount of interest in it. And then you've got all this legislation this year and the Tax Cuts and Jobs Act, and we're seeing what's going to happen going forward in the future. It's just the current climate right now is ripe to do life insurance and to meet with people on it, both to address needs for right now as well as planning for the future. And so we really cranked and pushed because we wanted to get this out early to everybody so you can start taking advantage of it. But we've put together the most robust life insurance package that we've ever done in the history of the company. We've got over 40 different things in this entire package. And if you look at that, we've got basically split out in a few different things. So we've got a ton of consumer-facing unbranded pieces built into this, all optimized for whether you're going to meet face-to-face or virtually. We cover essentially every target demographic, whether it's individual consumers and millennial, X, boomer, senior, whether you're talking about the business owner space, because again, going back to the Tax Cuts and Jobs Act, that was a business bill. One of the key provisions in there was 199A, which is essentially an additional tax deduction for flow-through businesses. That was money that historically had always gone to the government. Now that's not necessarily the case. If they meet certain provisions, that money can be repurposed for life insurance. So the business planning space is a huge opportunity. But across any demographic, we've got pieces put together. And then we've got fact finders, prospecting templates. So whether you want to market and advertise direct mail, email, social, workshop, doesn't matter. We've got different pieces and packages in there that you can utilize. We also have a number of studies and fact sheets in there as well that all support the need for life insurance and why individuals should be looking at it. And then part of what we put together as well, as I mentioned, we've got probably 6 weeks worth of advertising on social media built into it. And then we've got a pre-formatted email drip. So if you're using MailChimp, Constant Contact, if you've got a CRM system that integrates, you can slot these email templates in there and generate response from individuals. So again, we've put together a ton of different pieces on it. You can see here some examples of the social posts that we've put together. You can see here some different examples of some of the email templates that we put together for that drip campaign. And again, with the email marketing, we've got, whether you're wanting to do drip emails, we've got templates for that, or whether you're wanting to do general advertising emails, we've got that as well. And then again, this is an example of one of the life insurance overview guides. We've got IAMS on this. If you're interested in getting something customized with your logo, just give us a call and talk to us about it, and we can help you with that. But in any case, everybody on the call today, you'll be getting one of the sales directors reaching out to you so we can get this package over to you. It's going to be a download link because there's just so much stuff in here, and we want to make sure that everybody gets it. So be on the lookout as well. We're going to have some additional emails going out here over the next few weeks on different packages that we're rolling out on life insurance. And then again, one of the big things is next Monday, that life insurance software training. I think when you see what the output is and how it really articulates the impact of income taxation on an overall retirement account and how you can help mitigate that risk and that uncertainty in retirement, it's a powerful tool. And so one of the great things about that is we can run those designs for you, and we'll have a special offer on that as well for you when we get to the presentation next week. So in any case, my name is Curtis Hawks. I appreciate everybody taking the time to be on the call today. And again, if you're interested in a custom marketing analysis, if you want to jump the line and get the sales kit, or have a case that you're working on, you want to talk to one of these concepts, we're here to help you. We appreciate the business that you do with us. And if we've got some people on here that haven't worked with us before, give us a call. We'd love to learn more about your business and how we can help you. So appreciate the time today. Thank you, everyone.